Hi, everyone. This is Tony D'Amico with Fidato Wealth. Hope you're doing well today and enjoying some of the nice summer weather we're having here in Northeast Ohio. And for our clients in other states, hope you're doing well also. So wanted to do a video just on the markets and kind of the things that we've done to manage client investments and consider even possible alternatives. So let's talk about that first. So as I've kind of stepped back and, obviously monitoring our current investments, comparing them to their indexes and their peers is a big part of what I do, the ongoing manager due diligence, but also kind of just stepping back and looking at economic data. So I do get economic reports from several different entities, from Vanguard, from Goldman Sachs, from BlackRock, from Dimensional Funds. So there's a good handful of, reliable economists that I'll follow and get their take on what's happening. With all that's happened, I just kind of take a fresh look at things and looked at, well, should we consider dividend paying stocks? So that's been in the news. So, I've researched dividend paying stocks in the past and wanted to take a fresh look. I'm very obviously conscientious and want to do the best that we can do for our clients. So that was the heart of behind this. But actually doing the research and looking at dividend paying stocks again, historically, we can't draw firm conclusions on dividend paying stocks as far as their performance, during a recession. Right. So we've had 2 quarters consecutively where gross domestic product has declined. That is the definition of a recession. So dividend paying stocks, it sounds great. Warren Buffett does not like to buy stocks that pay a dividend because to him, that's a sign that the company can't take that money and get a better return with it. It's choosing to pay that money out to its shareholders. So again, what we do know in the markets is that stocks outpace bonds over time. We know that small company stocks outpace large company stock performance, again, over the long run. We know value stocks outperform growth stocks, and we know highly profitable companies outperform lower profitability companies, again, over time. So there's enough data going back to 1926 where there is statistical significance there. And that's where we want to, kind of lay our head is on the evidence. So there is unfortunately no evidence with dividend paying stocks that they're going to perform better in a recessionary period. It's not been the case. Inflation protected bonds also is something that I've looked at many years ago and still looked at them kind of with a fresh eye recently. Inflation protected bonds tend to, move, those prices tend to move pretty quickly. So inflation protected bonds already kind of spiked in value, really ahead of inflation really being in the news more so. So again, inflation protected bonds also have longer periods of underperformance. So that's very important to note. I think that's important for an investor too, because many investors don't want to hold an investment that's going to underperform in the time when typically regular bonds are doing well. So that, that is also a more difficult investment to own. Options, we hear about options, on different advertisements. So options, can be a good investment strategy, but options are also very expensive. They require timing really to be successful, very close management. Technology stocks. So technology stocks is actually already in our client portfolio. So the S&P 500 is roughly comprised, that based upon the value of the companies, is the S&P 500 is roughly 25% in the technology sector. So that may have fluctuated a little bit with technology stocks have dropped since the beginning of the year. Commodities, so things like gold and silver and other commodities. So commodities also have a terrible historical record, right? There is no evidence in the returns of commodities. They have not performed with any any degree of consistency or reliability. So the other thing that we, really I took a look at is, there's a hedge fund manager that's about to retire, and he has something called an all-weather portfolio. So I was really curious. So I looked at that as well. And what I really kind of saw was, I would say, a very similar philosophy: being globally diversified, having some assets that are not correlated. And our portfolio, after looking at that kind of what he calls all-weather portfolio, and looking at our portfolio, I believe they're built with the same philosophy in mind. In fact, I actually think our portfolio even has more diversification. So, the portfolio does have not just large cap stocks, but mid cap, small cap, value, international, emerging markets. Real estate is a great diversifier. Different aspects of bonds, most of them domestic, a little bit global, short-term bonds as well. Obviously we never bought into the cryptocurrency thing, right? So cryptocurrency, crypto has crashed. It's starting to come back a little bit, but has some severe declines. So I guess what am I getting at here in a nutshell? After just taking a fresh look at everything, stepping back, I realized the portfolio is exactly where it should be. The one thing I did consider was actually making the bond part of the portfolio a little bit more conservative. But again, actually, after taking a look at that, we do have 5% for our clients that's invested in a fund that invests in short-term debt instruments. It maintains the value of $1, so that the value of that investment doesn't fluctuate. Just what interest you receive fluctuates. So the portfolio is built to both for good times through the equity exposure and through tougher times with how the bond portion of the portfolio is really intentionally has been designed. So again, the result was to stay the course and rely upon discipline. And for those of you that haven't seen the previous video, it talks about our playbook that we take advantage of when markets are down. So and the other thing that I guess the last thing that I wanted to share with you is, our clients own institutional funds in their portfolio, or low cost funds. And sometimes when people think that they have an institutional fund, you're not really seeing any changes on a day-to-day basis. But the institutional managers that we use, it's important to note that they have offices and even campuses of people in different locations, even globally. So they have campuses of people. They have portfolio managers, analysts that are evaluating the positions in your funds on a daily basis. On a daily basis, they're looking to determine, should they make changes to the holdings of the fund? Is there a better buy out there? Is there something that maybe that hasn't performed well where they want to change that investment? So on a daily basis, both with your stock funds and your bond funds too, specifically with the bond funds, which I think is very important in this current economy, is they're looking at how these individual bonds that are owned in the funds that you have, how they're trading, what price is being paid. The reason why that they do that is that a credit rating agency changes the credit rating kind of like after the fact, after everyone else kind of knows that, okay, this bond has been moved from an investment grade to a junk bond status, right? So all of the bond funds that we utilize invest in investment grade bond fund or investment grade individual bonds. So they're managing that risk there. So they do that on a daily basis. So again, campuses of people that employ, again, ongoing monitoring, analysis, And they also have very patient and flexible trading guidelines. So one of our institutional managers has an unbelievable reputation, not just in the US, but globally, but their portfolio managers will give the traders options. They'll say, okay, you can buy stock A at this price, stock B at this price, or stock C at that price. So they're very patient and they drive hard bargains, if you will. So they're very good at trading, very patient, very flexible. That is a very unusual way to go about trading. So in fact, actually doing some due diligence, because I do that ongoing due diligence for the funds that we use for our clients, I will compare their performance compared to their index and other peers that have very similar funds. So I'll use a couple of examples. So one is we use Dimensional's US Small Cap Institutional Fund. For the past year, it's down negative 4.03%. So down 4%. This is as of July 31st, 2022. The benchmark, right? The small cap benchmark is down 14.29%. So the fund is doing 10% better than their benchmark. So I had a really great conversation with a client last week. And the question was, Tony, I'm still just, this is his first time working with an advisor. And he said, Tony, I'm just trying to get used to paying management fees while the market's going down. So my first comment was, well, I wish the markets only went up, right? But that's not how the markets work. But I explained it to him. Yes, we do provide value when the markets are going up. I really believe we provide even more value during times of volatility. So you can see in this case, if somebody just owned, and even just looking at the very popular Vanguard small cap fund, index fund, it's down 11% over the past year. Dimensionals is down only 4%. So that's a 7% difference. So if somebody owned that Vanguard small cap fund during the same period of time, this is before management fees, they would have lost 7% more of the value. So what we do is not only try to capture more of the upside, we also want to capture less of the downside. So very important to note. And even over the past 3 years, you can see that Dimensional's fund has outpaced all the others on this list. It's over the past 3 years, it's averaged 11.05%. This is according to Morningstar. Vanguard's small cap fund is only 8.56%. So you can see there, that is a significant difference. So over about 2.5%. Just another example to kind of share with you is the Emerging Markets Fund. It for the past year, it's down 15.43%. Now, this is a small piece of the portfolio for diversification. But if we look at that compared to other popular funds, so for example, BlackRock has a comparable emerging markets fund. It's down negative 20.71%. So again, what we see is a little bit more than a 5% difference. But over the past 3 years, Dimensional's fund has averaged 3.76% per year, but the equivalent at BlackRock has only returned 0.7%. So I'm giving you kind of maybe a little bit of a taste of the cooking, giving you some behind the scenes information, but I think this is really important. Again, the takeaway is on a daily basis, the managers we have selected are doing their work, which is very important. And I wish the markets only went up. Markets have stabilized a little bit, have calmed down a little bit, have gone up a little bit this week. And we kind of have to remember the investing fundamentals, right? I've always told clients when we're onboarding them, there is no plan B. We have to stay 100% disciplined to the investment, philosophy, right? If once you start deviating from it, that's when you start to lose money, is making the wrong decision at the wrong period of time. So conversely, I would just say, really the focus should be is how do you take advantage of this for the benefit of you and your family. So again, I encourage you to look at our YouTube channel. You'll be able to identify the video where we talk about the opportunities at hand, and we review kind of what our playbook is, what our internal playbook is to take advantage of market volatility. So I hope this video helped. I thought it was going to be 5 minutes long, but I haven't quite mastered that yet. So, but I do hope you enjoyed the information. If you liked the video, we're hearing, during our client meetings, just how helpful these videos are. Thank you for sharing that feedback. Would welcome any feedback as well. If you want to email me, that'd be great. But again, hope this information helped. And, we hope you and your families have a great weekend. Thanks. And thanks for watching the video. Take care.